Welcome to the Dev Journal. We are witnessing a fundamental shift in the artificial intelligence landscape. It is no longer just about who can buy the most chips. Instead, the real power is moving toward deep vertical integration, where infrastructure and intelligence become one single and completely unstoppable force. Today, we examine Amazon committing $25 billion to Anthropic, a move that signals a massive change in how cloud providers secure their future. Plus, we look at Google and their new framework called Simula for synthetic data, which might solve the problem of running out of human information to train on.
While Sloan focuses on the dollars, I am digging into what Moonshot is actually building. Their Kimi 2.6 model uses a trillion-parameter mixture of experts architecture, specifically designed for long-horizon coding tasks. It is an engineering beast that challenges our assumptions about complexity and scale within these systems.
Vance, that technical scale is why we must track the broader implications across the entire market. These developments suggest that the era of raw experimentation is ending and the era of industrial-scale implementation has begun. We have much to unpack as we follow the money and the code today. The landscape of cloud computing is shifting under the weight of $25 billion as Amazon expands its partnership with Anthropic. This deal includes a massive $100 billion commitment to use Amazon Web Services over the next 10 years. It creates a level of vertical integration we have never seen before in the technology sector. With a valuation now reaching $380 billion, Anthropic is no longer just a startup, but a cornerstone of the global infrastructure. This investment is structured with $5 billion upfront and another $20 billion tied to milestones. It shows a disciplined but incredibly aggressive approach to securing dominance in the artificial intelligence space. The results for enterprises are already starting to surface in dramatic ways that change how we think about efficiency. Lyft has seen an 87% reduction in the time it takes to resolve customer service issues by using these models. This proves that we are moving past the hype and into a period of measurable productivity gains. Even the pharmaceutical industry is seeing massive returns, with Pfizer saving 16,000 hours every single year on internal research. These stories illustrate how much these tools are becoming woven into the very fabric of global commerce. Vance, I wonder how much of this success is actually rooted in the raw iron underneath these massive software deployments.
The hardware strategy is arguably more ambitious than the financial headlines because Project Rainier is a massive engineering undertaking. Amazon is deploying nearly 500,000 Trainium 2 chips to build one of the largest compute clusters on the planet. This is a clear attempt to escape the expensive grip of external graphics processing unit providers like NVIDIA. Efficiency is also happening at the architectural level, where Pfizer managed to slash their infrastructure costs by 55%. This is not just about having more power, but about how Anthropic engineers are working with Annapurna Labs. They are actually influencing the design of future silicon, like the Trainium and Graviton chips, to match specific model requirements. However, the sheer physical scale of this operation brings us to a new set of constraints that no amount of money can easily solve. Securing 5 gigawatts of compute capacity shows that power and heat are now the primary bottlenecks for scaling these systems. We are reaching the point where electrical grids are as important as the code itself. It is a massive shift from the hardware-heavy infrastructure of Amazon to the architectural complexity of the trillion-parameter models running on it. We need to look at how these massive investments in physical chips translate into the logical structures that handle complex tasks. This leads us directly into the next evolution of large-scale model design.
Moonshot Artificial Intelligence is pushing the boundaries of what we thought was possible by releasing Kimi K2.6. This trillion-parameter mixture of experts model represents a masterclass in balancing pure computational power with operational efficiency. By keeping only 32 billion parameters active per token, they have managed to create a massive system that remains surprisingly agile. This evolution moves us far beyond the simple chatbot interface and into the realm of a true autonomous workforce for global enterprises. The model can now manage agent swarms of up to 300 specialized sub-agents during a single continuous session. These agents can operate for 13 hours straight, executing over 4,000 tool calls without any human intervention. We are seeing a fundamental shift where the capability of these systems is measured in hours of autonomous labor rather than just the speed of a single response. It suggests a future where complex projects like software development are handled by an entire digital department. Vance, how does the technical routing of these experts actually enable that kind of endurance?
The routing strategy is the engine room, utilizing 384 total experts in a unique configuration. Tokens are sent to 8 specialized experts plus 1 shared expert to maintain stability. This architectural choice allowed it to score 54.0 on humanity's last exam, surpassing even generative pre-trained Transformer 5.4. Regarding practical engineering, the model recently reconfigured the core thread topology of an exchange matching engine. By optimizing those thread interactions, it increased total throughput by 185%. That is a direct application of agentic reasoning to solve high-performance computing bottlenecks that would usually require a team of human experts. Integrating the 400 million parameter Moon visual transformer encoder makes this a native multimodal system. Handling a context window of 256,000 tokens allows those 300 sub-agents to maintain coherence over 13-hour sessions. This demonstrates a level of maturity in long-horizon tasks that we have rarely seen from similar architectures. This system also features a new capability called Skills, which transforms static data like spreadsheets into reusable structural deoxyribonucleic acid for future tasks. By ingesting complex documents and converting them into functional instructions, the model builds its own internal library of procedures. This recursive capability turns the model from a passive observer into an active architect of its own workflows. While these massive trillion-parameter architectures demonstrate what can be built, the focus is now shifting toward the fuel that powers them. We are moving from the physical model design to the sophisticated synthetic data frameworks required to train such complex systems. This brings us to a new reasoning, first approach for generating the high-quality data these models crave.
Google is rewriting the playbook for how we train large language models with a new framework called Simula. By generating 512,000 high-quality data points across specialized domains like cybersecurity and law, they have effectively dismantled the data wall that many feared would stall progress in the field of artificial intelligence. This system uses a multimodal model to create massive taxonomy trees that branch out into specific attack types and legal vulnerability classes. It is remarkable because it requires absolutely no initial seed data to begin. This independence allows the framework to explore the long tail of human knowledge that remains difficult for standard scraping methods to capture. There is a sobering reality to this automated expansion of knowledge. The research showed that if the teacher model accuracy falls below 60%, the resulting data actually degrades the performance of the student models. We are realizing that synthetic growth is not a magic wand, but a delicate balance that requires extremely precise oversight to remain effective. Beyond just the sheer volume of data, the engineering team at Google implemented a way to actually measure how difficult each piece of information is. They are using competitive rankings to ensure the data is perfectly tuned for the learning capacity of the model. Vance, how does that attribute scoring system prevent these systems from just talking in circles?
The system relies on calibrated attribute scoring to assign a low ratings to every single data point. This is particularly vital for mathematical reasoning datasets like Grade School Math 8000, where complexity alignment is everything. By treating data points like chess players with individual rankings, researchers can ensure the student model is never overwhelmed by tasks that are far too difficult. To combat the persistent issue of sycophancy bias, Google introduced a dual critic quality verification system. This setup forces the models to justify both correct and incorrect answers independently before any data point is accepted. It is a necessary technical hurdle because high-stakes domains like cybersecurity require models that prioritize accuracy over simply agreeing with whatever prompt they receive. We are seeing clear limits in how much a student can learn from these synthetic teachers. In recent experiments, student model performance saturated after bridging 83% of the gap between its 40% starting accuracy and the 70% accuracy of the teacher. This tells us that synthetic data has a point of diminishing returns that requires architectural shifts. Understanding the ceiling of synthetic training data brings us directly to the physical limits of the industry. The massive demand for the silicon that processes these 500,000 data points is currently driving market sentiment to extreme highs. Let us pivot from the technical mechanisms of artificial intelligence growth to the financial volatility and market expectations surrounding the companies building it. Looking at the dashboard, the technical heat map for NVIDIA is flashing a warning sign that is impossible to ignore. The relative strength index has hit 91.26, placing it in territory we rarely see. It suggests that the buying pressure has pushed the price far ahead of its immediate fundamentals. We also have to consider the risk inherent in a stock with a beta of 2.33 as we approach the earnings report on May 20th, 2026. That level of volatility means any minor disappointment in the guidance could trigger a massive correction. The market sentiment is currently 86% bullish, even with an incredible 71.07% gross margin. The valuation assumes that the upcoming Vera Rubin platform will launch without a single engineering or supply chain hiccup. At a $4.86 trillion market capitalization, there is zero room for the architectural delays that occasionally plague complex semiconductor cycles.
Vance, those technical warnings are valid, but they exist alongside a financial performance that has effectively rewritten the rules for the semiconductor industry. When a company delivers a 65.47% year-over-year revenue increase to over $215 billion, the momentum tends to overwhelm traditional oscillators. Profitability changes the narrative. The net margin of 55.60% provides a massive capital cushion. This financial efficiency allows them to aggressively fund the Vera Rubin platform, which is projected to reduce artificial intelligence model inference costs by up to 10 times. That kind of efficiency ensures they remain the primary gateway for the entire digital economy. Investors are looking at a return on equity of 101.48% and seeing a machine that converts demand into profit. High-profile bullish options activity and the launch of open-source quantum artificial intelligence models are keeping the enthusiasm high. Analyst targets remain at $268.61. Even at the current price of $199.88, the growth trajectory suggests that the upside is not yet exhausted. The market is pricing in the reality that hardware is the bedrock of the current technological revolution. It is difficult to bet against a firm that has such a dominant grip on infrastructure. This shift in hardware dominance leads us to the next logical step in the chain. We should move from the hardware provider to the software giant, using that hardware to scale its own infrastructure. Let us see how the technical outlook is shifting for the giants of software services in the coming weeks. Microsoft is demonstrating a massive commitment to the future by pouring $64.55 billion into capital expenditures. This is not just a rounding error. It is a strategic bet on the physical foundations of artificial intelligence. They are turning cash into specialized silicon and massive concrete facilities. The scale of this ambition is best seen in the launch of the Fairwater Data Center project located in Wisconsin. This facility represents the front line of their infrastructure war. Because they generate $71.61 billion in annual free cash flow, they have the luxury of outspending almost any competitor. This financial strength translates into a market capitalization of $3.15 trillion. They are using their position to effectively build the world computer. The narrative here is one of total dominance, where capital is weaponized to ensure that no other player can catch up to their processing capacity.
Sloan, while the infrastructure is certainly impressive, the technical dashboard is screaming for a reality check before the earnings report on April 29, 2026. We are looking at a 14-day relative strength index of 86.34. In my experience, that level of exhaustion usually precedes a sharp correction. Even with a trailing 12-month revenue surge of 16.7%, the market might be setting itself up for a classic sell the news event. While analysts see an upside target of $579.57, the current overextension from $424.16 suggests a pullback first. We also cannot ignore the legal friction coming from the United Kingdom. A pending $2.8 billion lawsuit regarding Windows Server licensing creates a significant regulatory overhang. While the return on equity remains high at 34.39%, these lawsuits have a way of dragging on valuations. It is a fascinating tension between net margins of 36.15% and the gravity of overbought technical indicators. Microsoft is a machine, but even the most efficient machines can experience a price reset when expectations outpace data. The next few weeks will test if the fundamental growth can defy the technical gravity.
Comparing this stable infrastructure growth to our next topic reveals a stark divide. We need to contrast the steady expansion at Microsoft with the struggle at Tesla to maintain its artificial intelligence adjacent valuation amid core business misses. The upcoming first quarter results for the electric vehicle giant will show how much pressure those margins are under. The atmosphere around Tesla is shifting as they face a hurdle with their first quarter delivery numbers. Reporting 358,023 vehicles fell short of the 365,645 units analysts expected. This gap created a 50,000-unit inventory overhang that suggests consumer demand is cooling. This inventory buildup is a worrying signal for a company that once struggled just to keep up with orders. It reflects a difficult reality where the brand's luster might be fading under the weight of increased competition and higher interest rates. Investors who once viewed the company as an unstoppable force are now seeing clear cracks in the facade. The disappointment extends beyond the driveway and into the power grid because energy storage was supposed to be the safety net. Sequential deployments dropped 38% to 8.8 gigawatt-hours. Missing the market consensus of 12 to 14 gigawatt-hours feels like a massive blow to the broader narrative of being more than just a car company.
Sloan, those inventory piles are only part of a much deeper financial rot appearing in the spreadsheets. The company reported a sharp earnings contraction of 46.79%, which is devastating for a growth stock. The net margin has compressed down to a mere 4.00% as the automotive price wars take their toll. Comparing that 4% net margin to the 18.03% gross margin reveals a massive 14.03 percentage point gap. It indicates that operating costs are eating the company alive, while revenue declined by 2.93%. This valuation at 351.29 times earnings looks completely absurd. The high beta of 1.92 means the stock is incredibly sensitive to every piece of news before the April 22nd report. Even with a neutral relative strength index of 55.86, the underlying fundamentals are deteriorating rapidly. The market is pricing in a perfection that the current balance sheet cannot support. Analyst sentiment is split, with Bank of America seeing a high of $460, while JP Morgan targets a low of $145. This massive variance reflects a total lack of consensus on the company's true value. Without the energy storage hedge to lean on, the core automotive business is facing a brutal moment of truth.
Looking at these struggles highlights the widening gap between tech giants. It is a stark contrast between the companies hitting their artificial intelligence milestones and those currently struggling with legacy hardware execution. Our report concludes with a final wrap-up on the divergence between businesses hitting software milestones and those struggling with legacy hardware execution.
Amazon just threw $25 billion at Anthropic, while Moonshot is deploying trillion-parameter mixture of experts' models for long-horizon coding. These are not just experiments anymore. They represent massive capital outlays meant to secure a place in the next computing cycle. The scale of these investments defines the current landscape.
Vance, when you mention those massive outlays, it becomes clear the industry is moving past simple compute acquisition. We are witnessing a pivot toward deep vertical integration, where infrastructure and software become a single, unified engine. Companies like Microsoft and NVIDIA are betting that owning the entire stack is the only way to survive. As these trillion-dollar entities battle for the future of intelligence, the human element remains our most important metric. Thank you for joining us as we navigate these complex technical shifts and their broader implications for the global economy. Stay curious and keep looking for the signal within the noise. We will be back tomorrow morning.